All right, good morning, good afternoon, everyone. Welcome to our webinar, Startup Fundraising 201. Are you ready for your next round? Presented by Early Growth Financial Services. My name is Jason Kennedy. I'm the Director of Marketing here at EGFS. I'll be your moderator for today. Just a couple of quick notes on the front end before we get started. This is a presentation that will last roughly an hour with Q&A that we will address at the end of the presentation. There's a questions panel in the GoToWebinar console there on your screen. So any questions you have throughout the presentation, please feel free to use the questions panel. We'll get through as many questions as we can during the Q&A period towards the end. Anything we can't get to during the presentation, we'll of course be happy to follow up with you directly to address those questions. There will be a recording made available. So if you have to drop out or need to refresh on some of these points, that will be made available to you as a registrant as well. So without further ado, I'd like to first introduce Scott Bryan from Imagine H2O, who would like to say a few words before we get kicked off here. Scott, good morning over there on the West Coast.
Great, Jason. Thanks for doing this, and all of the companies participating. We're just really happy to have you on the call today. This is the kind of value we can provide, not just to Imagine H2O portfolio companies, but to our broader ecosystem. We want innovation to win in the water sector, and it's partnerships and events like this that really enable us to have a broader reach. Early Growth Financial Services has just been an excellent partner of ours in helping a number of our companies, but I'll say that they're in a real expertise is working with venture-backed companies outside the water sector. And that's really one of the, I think, the strategies that we've successfully used with our companies is giving water entrepreneurs access to the resources and thinking that startups outside of water have, and Early Growth is really well positioned to do that on the fundraising side and financial piece of it. I know David's not going to probably get into too much of a sales pitch, but you should definitely check out their website. I read their blog a lot of good tips for startups in general, and just to encourage you to use this company as a partner going forward. I would also close with saying, last year on the venture funding side in the water sector, it was, I think the number was below $150 million. So total, that's done in an afternoon on Sand Hill Road. So the numbers for water entrepreneurs are still a little daunting. That said, there's a lot of money on the sidelines, quite a bit of it in family offices and strategic investors. Entities that are really looking to become involved but are waiting for that thesis to emerge and some real winners to emerge. So what does that mean for you all and for the entrepreneurs that are really in the trenches? It means you have to get creative with the financing. You can't necessarily expect the venture community to be pounding on the door. So more and more we're helping entrepreneurs look at bootstrapping and grants and other ways to fundraise, and hopefully some of the perspectives and Q&A today we can get into what does that look like for you. So with that, I will turn it over to Jason, and I just say thanks to David Ehrenberg, CEO of Early Growth, very busy guy, and just really appreciate you taking an hour of your time to do this.
Great. Thank you very much, Scott, for having us today and for setting this up for us. And I think that's a great segue to introduce our speaker for today, founder and CEO of Early Growth Financial Services, David Ehrenberg, based there in the Bay Area. David, good morning.
Thank you very much. So first of all, Scott, that was an incredibly generous introduction, and I really appreciate it. Second of all, I'd like to thank all of you for jumping on the call and spending an hour of your busy mornings with us. So thank you for that. We've been very involved with Imagine H2O almost since the inception. I was a very active member of the Full Circle Fund, which is the original group that spun out Imagine H2O. And I think we've been sponsors of Imagine H2O since the first year. Is that right, Scott?
Yep. Yeah, definitely.
So this is an organization that we really, really believe in. Water innovation is an area that we really believe in. We've done a lot of work in the clean technology sphere. We've done a little less in the water sphere, although I think it's a very, very vital issue. I was watching Vice News on HBO just the other night, and they had a big report about the Southwest and all the different water challenges that they have and all the different disputes that are coming up. And I think over the coming decades, water is going to be a bigger and bigger issue, and I think all of you are on the forefront of that issue. So I commend you, and I think that you are ahead of your time, and it's great that you're out there, and we love the work that Imagine H2O is doing. So thank you all for attending. With that, I think I'll jump into the presentation. Does that make sense, Jason?
Yeah,
Okay.
let's do it. Let's start kicking off with what Early Growth Financial Services is about.
Fantastic. Okay. So the way I always describe Early Growth Financial Services, and as Scott said, I'm going to try and not do too much of a sales pitch, but the way that I always describe our firm is that what we do is not very sexy, but the space that we do it in is incredibly sexy. And the not very sexy thing that we do is we're an outsourced finance and accounting organization. We have 4 primary services that we provide. The first service that we provide is CFO services. And we have 46 CFOs. They're located across the country. And they do everything that a CFO would do at a larger company, but they do it on an outsourced basis. So they get very involved with budgeting, financial planning, fundraising, pricing. They also do all of the work that a CFO typically does in terms of supporting partners, working with auditors, working with insurance agents, working with commercial real estate brokers, working with lawyers. So they very much fill that CFO role, but they do it on an outsourced basis. And of our 46 CFOs, most of them tend to be in their mid to late 50s. They've all been CFOs for at least 2 venture capital-backed companies in the past. About 75% of them come out of a top 20 MBA program and work their way up the finance side of the house to become CFOs. And the other 25% came from a Big Four or regional accounting background. They became controllers and worked their way up the accounting side of the house to become CFOs. The second thing we do is transactional accounting. And we have about 95 accountants, senior accountants, and controllers. And they really do the day-to-day blocking and tackling for our clients from an accounting perspective. So they're doing accounts payable, accounts receivable, payroll. They're doing all the general ledger entries. And they're closing the books on a monthly basis according to generally accepted accounting principles. They're doing things like producing financial statements and making sure that all the accounting is in order. The third thing we do is taxes, and we do state and federal taxes, and we also do R&D tax credits and all the different tax and compliance issues that our clients encounter and need help with. And then the last thing that we do is valuation services. And we do some higher end valuations, but for the most part, the valuation work that we do tends to be 409As, which is just the stock option valuations that you need if you give out stock options to your employees and you're a privately traded company. So that's the non-sexy, boring stuff that we do. We're a finance and accounting organization. But the space that we do it in is incredibly sexy. And as Scott and Jason both said, we primarily work in the venture capital back space. We have 850 clients that are privately funded venture capital backed companies. It's about 18% of the overall privately funded venture capital companies in the country. So we work with about 1 in 5 of the privately funded companies. We have offices in San Francisco, Silicon Valley, LA, Seattle, and New York. And that's basically it. We've had on this slide, there's a lot of different companies that we have worked with in the past and when we worked with them, they typically had 20, 25 employees, and then they went on to do great things. Probably the most well-known companies that we've worked with are companies like Indiegogo and Uber and Lux Valet and TechShop. But we get to work with all these companies when they're very small. Okay, that's enough for the marketing and sales perspective from early growth. Going forward, we're just going to talk about fundraising. If you have questions, Jason, they're able to type their questions if they have questions, correct? And we can answer them as we go through the presentation?
Yes, use the questions panel in your GoToWebinar console, and we'll get through as many as we can today.
Absolutely. And then we'll also leave a little, or we'll try to leave a little bit of time at the end of the conversation to take questions. Correct, Jason?
Yes, we will have a Q&A period as time allows at the end. Correct.
Fantastic. Okay. So the things that we're going to talk about today are, why do you want to raise funds? What are your funding options? We're going to talk about the process. We're going to talk about how you actually go about networking and raising those funds, what the business development process is like for raising funds. Then we'll talk about what investors want to see, and then what are some of the challenges once you have funding. Do you want to flip to the next slide? Fantastic. So the first question is, why should you raise funds? And I think this is a really important question and deserves some contemplation and some time thinking about it. As Scott said, there's only been $250 million in funding for, did you say 250, Scott? Was that the number for funding for water startups in 2016?
It's actually more depressing. Last year was 150, or actually slightly below 150. So there was a drop from the year before, which was closer to 250.
Wow. Wow. So in that kind of a landscape, it's always important to think about alternative methods. So if you're not going to be able to raise venture funding, it's oftentimes, there's a lot of other methodologies that you can use to raise funds, and we'll think about that. So that's the first consideration. Do you have a business that venture capitalists are going to be interested in? The second question is, do you really need venture capital funding? Is this an idea or a business that you can bootstrap, get to initial revenue? Can that initial revenue actually support your future growth? Can you get debt financing that's associated with that initial revenue, an AR line of credit or other types of debt financing that will allow you to grow without getting venture funding? Are there other methodologies that you can utilize to get your initial funding, whether it's crowdsourcing or other types of investments? You really only want to get venture funding if it's your last alternative. If you need the money in order to grow, if there's a huge market that you're going after, if you're looking for accelerated, fast-paced fundraising, those are the kinds of questions that you need to think about. And please keep in mind that 99.9% of new businesses that are started in the United States every year don't get any external funding. I think because someone has a technology startup or because they're in the technology space, they always tend to think about VCs and private equity, but there's a lot of other options available, and the majority of companies by far in the United States don't ever go down this road. So take a serious hard look in terms of thinking about funding. Let's go to the next slide, Jason. So depending on the stage that you're at, there's different funds that there's different ways of fundraising that make a lot of sense. So when you're first starting out, you want to flip to the next slide, Jason. When you're first starting out, oh, that's venture debt. I apologize. I thought it was the friends and family slide. Is there a friends and family slide that we have, Jason, that you can flip to?
No, we kind of distilled that down to this single chart here.
We did. We distilled it down into a single chart. I apologize, Jason. So when you're first starting out and you're raising money, oftentimes the first step you do is you go out to your friends and family. And this is very, very typical. You reach out to your parents, your sisters, your brothers, your aunts and uncles, your best friend from college. And that's the first initial raise. And that's very, very typical. The one caution I would have is that at this stage, 90% of companies fail. So if you're going out to raise money from your friends and family, always make sure that it's money that's not going to put the relationship in danger. So you don't want to take half of your grandmother's retirement money. You don't want to take the last $100,000 in savings from your college roommates. Make the assumption that chances are this money will be lost and will never be repaid. and make sure that you're never endangering the relationship. So that's the first stage and the first folks that will provide money. The second stage is angels. And angels are any high net worth individuals who, in addition to making investments in the stock market or in real estate, also are investing in privately owned businesses. And there's really three types of angels that we think about. The first is just individual angels that are out there in the network. The second is super angels. And this is a breed of investors that really have appeared over the last 5 years. And super angels tend to be folks like Dave McClure or Ron Conway or Paige Craig, individuals that are very, very high net worth individuals and who make a lot of investments in the early stage market. Their investments typically range anywhere from $25,000 to $100,000. But they approach the investments much more like a venture capital firm as opposed to a typical angel. They typically have teams that work for them. They typically have a similar due diligence process to a venture capitalist. And they tend to make investments at the same rate as a micro VC or ordinary VC. The third group of angels is angel groups. And in every city in this country, there are angel networks. And these are individual angels who come together so they can share deal flow, so that they can collaborate on due diligence, and so that they can co-invest together. So oftentimes after a friends and family, angel rounds are the next typical round. And we typically see angel rounds falling in the neighborhood of $250,000 to $500,000. After an angel round, typically the first round of investing is your first institutional round. And at this point, a lot of companies are looking to micro venture capitalists. And micro venture capitalists that's a relatively new term in the venture capital marketplace. Micro VCs are smaller funds. They typically have $100,000 or less in capitalization. They tend to really focus on the early stage. So they do a lot of seed investments and a lot of Series A investments. And they tend to have a very specific focus. So instead of investing all across the technology landscape, they'll pick a particular area and really focus on it. So they'll pick something like Luma Capital is a micro VC that I'm thinking about, and they really invest in marketing and sales automation tools. And that's really their focus. Forerunner and Mavrunner, micro venture capital firms that really focus on companies that are doing retail innovation. So micro-capitalists tend to be very specifically focused. And then obviously beyond the micro-venture capitalists, as you get into your larger rounds, your Series B round, your Series C round and beyond, you're really looking at traditional venture capitalists. And these are the folks that live up and down Sand Hill Road. So these are the Sequoias of the world, the Kleiner Perkins of the world, and the Andreessen Horowitz of the world. And those are the different levels of equity investors. Should we go on to the next slide, Jason, and talk a bit about venture debt? So in addition to equity investors, there's also different ways to enlarge the amount of money that you raise and to really extend your runway. And when I say runway, I'm talking about the length of time that your company has before it runs out of cash. So one of the best ways to extend your runway and to really fight against dilution, giving up too much equity, is when you think about doing an equity raise, also think about venture debt. And venture debt is debt, it's true debt that needs to be repaid, but it's typically associated with raising an equity round of capital, and it's non-dilutive. So there's an interest rate associated with it. There's typically a little bit of warrant coverage, which is like a call option on your equity, but the equity impact is fairly minor. But it's a nice way to extend your runway by $1 million or $2 million. most of the venture capital technology banks, most of the technology banks that focus on the venture capital marketplace provide venture debt. So Silicon Valley Bank, Square One Bank, Bridge Bank, and Comerica all provide venture debt. But then there's also a few different venture debt firms out in the ecosystem that all they do is provide venture debt. These are firms like Western Technology Investments, WTI, Hercules, and TriplePoint. Should we go on to the next slide, Jason? The other thing when you're thinking about raising equity money, especially at the early stage, that you should think about is convertible debt. And convertible debt is something that's become much more acceptable and commonplace for early stage investing. And this is typically when you're raising your first round or your first couple rounds, instead of actually setting a price on your company and selling equity, instead what you're doing is you're creating a convertible note or a convertible debt instrument that operates as a loan, but when you raise your next institutional round, that debt converts into equity at that point in time. So let's say you do a seed round, you raise $2 million, but instead of doing it as equity, you do it as convertible debt. Then a year and a half from now, you do a Series A round and you raise $4 million. That initial $2 million that you raised during convertible debt converts into equity at that point. And there's several advantages to this. It's much cheaper than doing an equity round. It takes a lot less time than doing an equity round. And you don't have to decide on a valuation when you first start your company. You can decide on your valuation after you've shown some traction and hit some of your key milestones. So hopefully your money will convert at a much higher valuation than it would originally. A couple key terms for convertible debt. There usually is an interest rate associated with it because it is debt. There's typically a discount, which is at the point that it converts into equity, it does so at a lower rate. And there's typically a ceiling, which says that if my company is valued beyond X amount, I will only convert at Y amount. So it's a little bit complicated, but it's an area that you should be aware of. We're seeing it a lot more at the seed and the Series A level. A lot of first institutional investors are coming in with convertible debt, and it's my personal belief that it's much more advantageous to entrepreneurs to get convertible debt than to get equity at the initial stages. Jason, you want to jump to the next slide?
Yeah, we had a quick question come in. Is this similar convertible debt? I mean, we know the answer to this, I think, but is this similar to a SAFE document?
Oh, that's a great question. That's a fantastic question. So the question is convertible debt similar to a SAFE document? I should have talked about that. So a SAFE document is Y Combinator's solution to convertible debt. Y Combinator is a very large accelerator and business plan competition that's in the United States. It's probably the most impressive accelerator in terms of companies that really have gone on to do something else. It was started by Ron Conway in the Bay Area. And Y Combinator came up with their own convertible debt instrument called a SAFE document. The primary difference between convertible debt and a SAFE document is that a SAFE document is equity. So it's contained in the equity section of the balance sheet. And so it's equity that converts into a different form of equity. A convertible note is debt that converts into equity. I don't see a huge advantage or disadvantage to using either. I think it's just a personal preference. We see the SAFE documents a lot more in the Bay Area, and we see convertible notes and convertible debts a lot in different parts of the country. Do you want to jump on, Jay?
Great, thanks.
Jason?
Yeah, let's jump over to the fundraising game plan.
So when you think about fundraising, it's a huge business development process. And the old guideline used to be that you should give yourself 6 months to really go out there and raise money. Give yourself a 6-month runway. The funding environment has actually slowed down a little bit over the last 12 months, and we're actually advising our clients to give themselves 7 or 8 months. But it's a long period of time. It takes some time, and it's typically the most difficult and challenging business development process that a company is going to go through. So provide yourself with a good length of time, and then really create a game plan of how you're going to go after this money, how you're going to attack it, and what your plan is for raising it. Very similar to creating a sales plan or a marketing plan for your company and for your products and services. Do you want to go to the next slide, Jason? So we talked a little bit about this. It's a business development process. You want to give yourself at least 6 months. We're advising that you now at this point give yourself 7 or 8 months. And you really want to go to the next slide, and we'll talk about targeting, Jason. As part of this, you really want to target who your correct venture capitalists are. So we talked a little bit before about which investors make sense at different stages. So keep that in mind. Are you raising your first money, in which case you probably want to think about friends and family and angels? Are you raising your first institutional round, in which case you want to probably think about micro VCs? Are you later on down the line, in which case you want to think about traditional VCs? But think about who your target investors are, and then once you figure out the types of investors that you want to be involved in this round, you need to think about what are their characteristics. Are these investors that are investing in water startups? Are these investors that are investing at the stage that you're at? And are these investors who are investing in the region that you are? So at this point in time, there's investors who focus all across the United States, but then we also see a lot of investors who are regionally focused, investors who just invest in the LA marketplace, or investors who just focus in the Midwest. So think about region, think about stage, and think about sector. So really think about those 3 things. And even within different firms, there can be different partners who focus on different regions, different sectors, and different stages. So you basically want to build a list of who all of your target venture capitalists are and who all of your target investors are. Then once you build that list, if you can, you really want to avoid doing cold outreach. What you're really trying to do is get warm introductions into all these different investors. And so you need to network to figure out how to get into these folks. The best way to get in, or the easiest way to get in, is other entrepreneurs. So all of you are members of Imagine H2O. So if other Imagine H2O companies have gotten outside investment dollars or have relationships with venture capitalists, they can obviously make those introductions to you. Thinking about joining other organizations of entrepreneurs where you can get introductions to venture capitalists. Really utilize all the organizations that you belong to. But then beyond that, also utilize your service providers. All of you have lawyers. Lawyers are incredibly expensive. All of them are expensive. Try and pick legal counsel that can also help you with the investment dollars and can make introductions for you. Lean on your bankers. If you're using an accounting or finance firm like Early Growth Financial Services, lean on us. Really try and network into these folks as much as possible. You're really looking, once you build that target list, you're really looking for warm introductions to all these different folks. Should we go to the next slide, Jason? In terms of what you need to present to investors, this has become pretty rote. So at this point, venture capital has been around for over 30 years, which is crazy to think about, but it's been around for a very long time. And at this point, investors have gotten pretty picky and finicky about what they want to see. And this is not an area where you want to be super creative or super different. There are things that investors are looking for, especially in those first couple meetings, and you want to make sure that you have those different things. At a high level, you need 3 things. you need an elevator pitch, which is just a paragraph of, hey, this is who we are, this is what we do, and this is why we're special. You need an executive summary, which is typically a page to 2 pages. And what you need in that executive summary is very detailed, and you need to cover certain information, and it should be formatted in a certain way. And then the last thing that you need is a pitch deck, which is a PowerPoint presentation. And it's suggested that that PowerPoint presentation be 10 to 12 slides. I know that this sounds very subscriptive, but this is really what venture capitalists are looking for. There are 2 books on this subject that I really love. I should be completely forthcoming and say both of these books were written by friends of mine. So I am pushing books written by friends. So I just want to be clear about that. But the first one was written by Guy Kawasaki. And for those of you that don't know Guy Kawasaki, in the nerd geek culture of Silicon Valley, Guy Kawasaki is really a rock star. He was the first public spokesperson for Apple Computer, and he started GarageVentures.com in the late 90s. And he has written a book called The Art of Start. And he's actually come out with a new edition of it, a revised edition of it. But The Art of Start really talks about what you need to go out to present to investors, and he describes the 10 slides that you need in the pitch deck and what they should contain. The second book that I really love is by Mark Phillips. And Mark Phillips started the Google of Australia, sold it for a couple $100 million, and then moved over to the United States, to Silicon Valley, to start a venture capital fund called Arafora. And Mark has written a book called Inside the Silicon Valley, How the Deal Gets Done. And Mark actually does a chapter on each slide that you need in your pitch deck and what it should look like and what it should contain. In addition, Early Growth Financial Services has done several webinars on how to pull together a pitch deck, and that's really worth seeing. It's an hour presentation. It's all over our website. Jason, what's the easiest way to find that?
We've got a fundraising section in our blog. You click that, and you have access to all that stuff immediately.
And that's a great presentation because it shows examples. So it says, okay, these are the slides you need to have. Here are examples of these slides. Here are some guidelines on creating those slides. But so really make sure that you tailor your information to what the venture capitalists want to see. That doesn't mean that you can't have all sorts of backup and supporting information for the main slides that you're doing. You can't have a large appendix. Typically, our clients will go in to see a venture capitalist. They'll have their 10 to 12 slide deck, but then they'll also have 30 or 40 backup slides that they can bring up if things come in. The slide that we're all looking at right now has what those different key slides are that you need in your pitch deck. But once again, I would recommend reading both of those books, which are airplane reads. They're 3 or 4 hour reads, or watching our webinar. Guy Kawasaki also does a wonderful, wonderful presentation on what you need to pull together if you're a startup. And you can just look up Guy Kawasaki, and Kawasaki is spelled like the motorcycle, on YouTube. And you'll find all sorts of great presentations by Guy. Shall we move on, Jason?
Yeah, let's jump into financials.
Fantastic. Actually, let's go to the next slide after this financial slide. So there's 2 slides that you really need, 2 financial slides that you really need as part of your pitch deck. The first financial slide that you need is a tops-down model. And what the tops-down model is it's just a slide that demonstrates how large the market is that you are going after. And one of the things about venture capitalists is their investment thesis is that if they make 10 investments, they expect 5 of those investments to fail. They expect 2 or 3 of those investments to break even, and then they're hoping that they're going to have 2 or 3 that are huge home runs that have over 10x returns. And so every time a venture capitalist is making a bet, they're looking for a huge home run. That means that they need to have a really large market opportunity. And that's what this top-down slide does. The next the next financial slide that you need, you want to flip, Jason?
Absolutely.
The next financial slide that you need is a bottoms-up forecast. And this is typically a 3-year financial forecast. And there's a couple things that you really need to do when you prepare this 3-year financial forecast. The first thing that you need to do is make sure that you really understand all of the numbers, that you're not just trending it. You're not just saying, okay, I'm going to have $200,000 in revenue my first year, I'm going to have $1 million in revenue my second year, and I'm going to have $20 million in revenue my third year. What you really want to do is understand what the different drivers of your revenue are. Are you going to hire salespeople? How long will it take those salespeople to get onboarded? How long will it take them to get ramped up? On average, how many deals can they close a month? On average, what are each of those deals worth? What are they going to cost the salespeople? Making sure that you really have detailed assumptions built into your model that show an understanding of how you're going to generate revenue, but also what your expenses are in order to accomplish your key goals. So that's the first thing. Really make sure you understand all of those numbers. The second thing you really want to think about when you're preparing this slide is what are your key milestones? And one of the things that we really believe in is milestone financing. And this is the idea that every time you raise money, you want to raise money at a higher valuation. Every time you raise money, you want to make sure that your company is worth more than the last time you raised money. So you have less dilution. So if you raise $1 million today and then $1 million in 2 years, when you raise $1 million in 2 years, you want to give up less of your company than when you raise money today. In order to accomplish that, it means that you need to clearly understanding what the key milestones are that you need to drive towards to increase the value of your firm, and that when you raise money, you raise enough money to accomplish those key milestones. Should we move on, Jason? So funding requirements is a slide that we sometimes see in pitch decks, and what this really does is it ties directly into the milestone financing idea. You want to make sure that when you raise money, you understand clearly how that money will use and how it will allow you to achieve those key milestones before you need to raise money again. Should we move on, Jason?
Yeah, so we've hit kind of the fundraising part of it, so now we're going to jump into a little bit of section about after you've raised funds.
Should we stop for a second, Jason, and see if anyone has any questions on the fundraising piece of it?
So we do have a couple of questions here in the hopper, so that we can definitely jump into those. And as a quick reminder to everyone, if you do have questions, use the questions panel there in your GoToWebinar console. I have an interesting question that came in. I would like to get tips on how to avoid the preference clause when talking about bringing in new investors. Are you familiar with that?
In terms of the preference clause, most invested capital comes in as preferred stock, which means that your investors get a preference over your existing stockholders, and they get special rights and considerations. For example, if you sell the company or have an IPO, your preferred stockholders tend to get paid first. They also have different rights in terms of how the stock is treated, and they're treated in a very preferential way. It's very hard to avoid preferred stock when raising money from venture capitalists or private equity firms. Sometimes angel investors and certainly friends and family investors will purchase common stock, which has no preference. But when you're talking about institutional investors, it's very hard to get away from preferences. Other questions, Jason?
Yeah, we've got a couple more here. One around convertible debt. Is there ever an instance where you actually pay back convertible debt, or does it typically just convert to equity?
No, it typically converts to equity or you fail as a company. And if you're set up as a Delaware C Corp, then that debt dies with the company's death. And you all want to be set up as Delaware C Corp or at least as a C Corp so that your private assets are completely separate and distinct from the corporate assets.
Gotcha. A quick question from someone that's not in one of the typical big startup hubs here in the U.S. Any tips on researching and finding micro VCs in my particular area?
Yeah, so there are tons of lists and tons of information available on the web that talk about all the different venture capitalists that are out there and the different areas that they're in. TechCrunch and Crunchbase are two wonderful sources for that. But if you're in an area that's outside of a technology hub, there are a very large number of micro venture capitalists that are investing in companies throughout the country. So regardless of where you are in the country, you can still go to the micro venture capitalists that are located in the Bay Area or in LA or in Seattle or in New York and raise money from them, even if you are outside of those areas. I would think about trying to find folks for your team that have ties to those different venture communities. So think about perhaps getting a lawyer who has ties to the Bay Area, or banking with someone like Silicon Valley Bank or Square One Bank who has ties to those areas. Or when you're thinking about who your board of advisors are and who are the folks that are helping you out with the company, try and find folks that have ties to those types of investors. So you still want to think about those investors in the other areas of the country, in the tech hubs, as you said, but really try and figure out who can help you out in terms of networking with those folks. Other questions, Jason?
Great. Yeah, we've got one more question kind of around networking there, and kind of plays into the group here we're speaking to. This person has been meeting a few different angel groups in their area, but these groups are hesitant to invest, in a water space, water tech space, just because they don't have their own connections they can lean on in that particular business to be able to offer some guidance or possible diligence. Is there kind of any way around that, or is it on the entrepreneur to kind of make some sort of introductions like that? I mean, is there a way they can kind of get around that roadblock when dealing with these types of investors?
I would say that the easiest way is for the entrepreneur to make introductions to other folks that are in the ecosystem. You want to get the investor to a point where they feel confident and they feel secure. So talking to other folks that invest in the water space, talking to companies that are very active in the water space, talking to individuals that know a lot about the water space, all of those things will help. You want to try and do everything you can to get them comfort in your business idea, and especially in your business's ability to generate revenue and really create a strong company that people are interested in.
Nice, great. So that's the bulk of the questions, and we'll hit some more during our Q&A period there. And then we can jump back in here into kind of the post-funding world for accounting and finance for these companies.
Absolutely. So once you raise money, especially if you've raised an institutional round, it becomes very important that you have strong financial information. Typically, institutional investors are going to want you to report on your financial results on a monthly basis, and their expectation will be that your numbers are sound and secure and that they're prepared using generally accepted accounting principles. So if you have not set up a strong financial infrastructure for your company prior to receiving funding, once you receive funding, you want to make sure you do that. That means setting up an accounting system, whether it's Intuit QuickBooks or Xero or Intact or NetSuite, but setting up an accounting system. A lot of accounting systems are now available in the cloud, which makes them very easy to use. So you can set up a general ledger system, which is a system like QuickBooks or Xero or NetSuite. But then there's all sorts of other tools that are available today that you can get that are all cloud-based that will help you to have a strong accounting infrastructure. So things like Bill.com, which handles all of your bill pay and accounts payable. Things like Expensify, that handles all of your employee expense reporting. Things like Xero, which does online payroll for you. I'm sorry, things like Gusto, which does online payroll for you. But making sure that you have all the tools in place and an accounting system in place that makes sense. And then making sure that you've engaged with someone who really has a strong understanding of generally accepted accounting principles. Ideally, you want a CPA who understands those rules and regulations, and someone who you can trust to make sure that the system is, that your accounting information is entered correctly and presented correctly on a monthly basis. And once again, you're going to want this for your institutional investors. If you go out for any kind of debt, you're going to need this information. And I would argue that most importantly, you want this information to be correct and solid because it will help you to run your business and it will help you to understand exactly how your business is functioning and what's going on. You can think about your financial statements as your own personal scorecard that you have on a monthly basis. Shall we move on, Jason?
Yeah, I know we touched on this briefly already, but just a quick rundown of what is a runway and why is that important?
Right. We talked about runway at the beginning of this presentation, but probably the most important financial metric for an early stage technology startup is their runway. And this is just how much money do you have left before, how much time do you have left before you run out of money? And this is very important because obviously it's indicative of when you need to start the fundraising process again. And it also is indicative of how much time left you have before you need to hit your key milestones, the key milestones that we talked about when we were talking about your financial forecast. But you should always know what your time and money relationship is, and it should be something that's very close to the top of your mind. Next slide, Jason. This is just a way of tracking your runway. This is your cash burn sheet, which is something that we see on a very typical basis. Next slide, Jason.
Great. So the next slide, we're going to talk a little bit about just an overview of the cap table.
Right. So it's part of pulling together your financial information and making sure that everything is clean and well organized. It's also important to put together a capitalization table. And this is a table that shows who all of your investors are, how much they paid for their investment, and how much equity they own. And in addition to having a cap table that summarizes all this information, you need to make sure that every entry on your cap table has supporting legal documentation. So if you have given out founder shares, you want to make sure that you have legal documentation that supports these founder shares. If you have given out equity to your employees in the form of stock options or in the form of grants, you want to make sure you have legal information supporting this. And certainly as you begin to bring in angel investors and friends and family, and then go on down the road and start to bring in more institutional investors, you want to make sure that all this is supported with legal documentation and in your summary. This is an area where we see a lot of errors and a lot of folks that when they're starting out the company don't necessarily take the extra steps that they need to take to formalize and document the ownership. And this is something that can really hurt you in the future as you're moving forward and trying to raise later rounds, or if you want to be acquired. This is really one of those key things that you want to make sure is clean right from the very beginning. And yet another reason to make sure that you have someone who has a very strong understanding of your accounting and financial needs on your team right from the beginning. Jason, do we have anything left?
One more.
Oh, this is just a marketing slide. So basically, when you're thinking about accounting and finance and you're thinking about all these needs, this is what Early Growth Financial Services does. So this is always, there's an option of when you're thinking about finding these folks and engaging with these folks, this is just our slide to say, hey, think about us because this is what we do.
Awesome. So that takes us here into the Q&A. Our contact information is there.
We did it in 51 minutes, Jason.
Very nice. Very well done. So thank you, David, for all the expertise and the insight there. Just as a reminder, we will take a few more questions here as time allows. And then if you've got questions afterwards, we've got our contact information here. Or you can work through Ashley and Scott and the Imagine H2O team to reach out to us. We're happy to help and answer any questions we put to today. So as I mentioned, the questions panel, please keep those questions coming in. We'll jump into a few that we've got here. And actually, we've got a couple that have come in around this kind of topic, David, but I'll see if I can distill it down a little bit. But basically, they're LLC business entities that have taken funding. So should they be converting to C Corp at this point, or if they go for funding again, should it just be LLC? Should they just let it ride? What do you typically see and recommend in those cases?
When you're raising institutional rounds, it's much easier to be set up as a C Corp. It's much easier to divide part of the company and give up equity if it's set up as a C Corp. And it's much easier to give equity to your employees in the form of stock options or stock grants if your company is set up as a C Corp. So I would, if you're going to raise money, or if you have recently raised money, I would strongly consider setting up a C Corp as opposed to an LLC. Plus, it gives you as an entrepreneur and as a founder a much greater degree of protection. It really separates your personal assets from the business assets, which you all are creating high-risk startups. So the more separation that you can have between your house and your personal savings and your kids' college savings plan, as much separation as you can have between all of those things in the business, the better.
Now, this is probably a question for their lawyers, but how easy is it typically to migrate from LLC to C Corp?
It's fairly easy. It typically costs $8,000 to $10,000 though, so there is a price change associated with it. It's also, if you do it at year end or at the end of your tax year, it's much easier, because if you do it mid-year, then you're going to end up having to do federal tax returns for the LLC and federal tax returns for the C Corp. And if you're in a state like California or New York that requires state tax returns, you'll also have to do a separate one for the LLC and a separate one for the C Corp. And so that will double your tax fees. But from a legal perspective, it's fairly easy, but there is typically a cost associated with it. And I've seen that cost range from about $8,000 to $10,000.
Okay. Kind of a higher level question, thinking a little bit farther down the road, which is great, but question is, how much equity do the co-founders typically have at an exit? So that's assuming, of course, with the introduction of VC investment, maybe some angel money or convertible debt a little bit earlier along the way. What are founders typically walking away with percentage-wise?
So this has really changed over the last few years. It used to be that the common idea was, if you were creating a venture-backed company and you were going to go out for multiple rounds of funding, you wanted to finish the entire process with the founders still owning 20% of the company. So you would go out for your seed round, maybe you would give up 20 to 30%. You go up for your A round, you'd maybe give out 10 to 20%. And then with each subsequent round, you would raise more money, but give up a smaller portion of the company. And the idea used to be that you always wanted to, at the end of the entire process, be left with 20% of the company for the founders. That's really changed with the lean startup methodology coming into place, and with companies requiring less and less capitalization in order to be successful. And we're seeing founders own more and more of a percentage of their company. Obviously, you want to try and retain as much control as possible. And obviously, there's a big difference between retaining over 50% of the company and retaining under 50% of the company. Because once you give up over 50% of the company, obviously the company is no longer yours and you're a minority shareholder. So it used to be 20% at the end of the entire process. That's changed a little bit. The biggest thing that you want to think about is holding on to as much equity for as long as possible.
Now, at the early stages, how important is it to have prestigious board members or advisors as part of your company when it comes to fundraising?
I would say it's less important to have prestigious fundraisers or advisors, and it's more important to have folks that can really strategically help you. People who understand your business, who understand your sector, and who can help both in creating relationships with potential partners, who could help with generating your initial revenue, and who can help with your future fundraising needs. So as opposed to prestige, what I would really look for is value add, folks that can come in and can really contribute something to the board and to the company.
Okay, great. A question kind of along, I guess, an ideological perspective, but VCs versus angels.
These questions are all great. These questions are fantastic.
These are great questions. So this one, VC versus angel, do you typically see one versus the other that tends to more be favorable for the entrepreneur and their specific vision? Or do you see like an angel, for example, like trying to steer things what they think is the right direction, or maybe a VC doing that, a firm doing that?
I think both VCs and angels can be very involved in trying to steer the company in certain directions, but I think it's really individualistic. So there's some angels that add more value, and there's some VCs that add more values. Angel rounds tend to be your very early stage rounds and your first sort of cash into the company. It tends to take a lot longer to negotiate with angels, especially if you're working with an angel group. You may raise $300,000 from an angel group, but oftentimes that comes from 15 different investors who are each putting in $20,000. And so a lot of times working with angels, the due diligence process takes a little bit longer. The negotiation takes a little bit longer. And then once you have these angel investors on board, sometimes you can be herding cats a little bit. So it can be a little bit more difficult working with angels, but they're also much more likely to invest at an earlier stage before you have a lot of traction. And a lot of micro VCs are not going to be interested until you have that traction and that initial revenue. So sometimes you have no choice but to go with angels. That was a convoluted answer, but hopefully it made sense.
So I think we're going to hit one more question here, because I think this one may take a couple of minutes, and then we'll wrap it up there. Again, if we didn't get to your question here, we've got contact information listed right there. Please reach out to us at any time. But David, again, we've got a few questions coming in around this topic, so I'll try to shorten it into kind of a generalized question. But overseas companies looking to get U.S. investment, should they take kind of the Spotify? Yeah, should they take kind of the Spotify model where they prove traction in their local market and then bring it over, or should it be closer to the ideation phase to be able to kind of get in the door quickly in the U.S.? What do you typically see as far as what VCs and angel investors are interested in?
Right. So first of all, it makes it much harder to raise money within the United States if you're located overseas. There are some venture capital firms that are investing overseas. It depends to a certain extent on what country you're coming from. There's a lot of investors who are comfortable investing in UK companies, Israeli companies, Australian companies, and New Zealand companies. But there are a large number of venture capitalists that will not look overseas regardless of the country that you're coming from. So if you're an overseas company and you are thinking about institutional dollars, and you think that most of those institutional dollars are going to come from the United States, then I would strongly suggest setting up an office or a center of operations within the United States. Having folks over here either setting up an R&D center, setting up a sales and marketing center, or even thinking about relocating the company to the United States makes it much, much, much easier to raise money within the United States. Without operations in the U.S., without having a legal entity set up in the U.S., it becomes much harder for foreign companies to raise money here. Now, there is a venture capital community outside of the United States, especially in the different countries that have a strong focus on technology. So if you're in a European country, or if you're in Japan or China or some of the countries in Southeast Asia with a strong focus on technology, you can find local venture capitalists. But if you really are trying to tap into the U.S. institutional money, then you really should be thinking about setting up a legal entity and getting folks over into the United States.
Awesome. Great. Thanks for sharing.
Those were, can I say really quickly, those are wonderful questions. So we do a lot of webinars and we don't typically get this kind of detail in terms of questions, and these were really, really appropriate questions and great questions. And I'd be more than happy to answer any follow-up questions that folks have or questions that we didn't get to. So really, really great questions. So thank you very much for that. I really appreciate that. It tells me that you all were really listening and interested in the subject. So thank you.
Yeah, great. David, before we sign off, any final thoughts from your side?
No, just really appreciate the opportunity to talk with all of you. And we're huge believers in Imagine H2O. You all are out there doing really good work, and work that I think is going to be incredibly essential in the years to come. Water is a huge, huge issue that I think we're only beginning to grapple with.
Great. Okay, thanks, David, again for sharing your time and your expertise. Scott and Ashley and your team for putting all this together. A recording of this will go out to you within 48 hours. And then, of course, we're available via the method you see there in front of you if you want to reach out for any further questions. Otherwise, thanks for joining us today, and have a great rest of the week.
Thank you, Ashley and Scott. Appreciate it.
Thank you, guys. We really appreciate it.
Have a wonderful day, everyone.